All right. Hello, everyone. Welcome, and thank you for joining us for this presentation. It's my pleasure to introduce Avi Gilbert, the founder, and Ryan Walde, the lead cryptocurrency analyst of ElliottWaveTrader.net. To our wonderful viewers, if there's anything you'd like to ask Avi and Ryan today, please type it in the live chat box. Time permitting, I'll announce your questions at the end of their presentation so that they may answer them. And with that said, gentlemen, I'll hand the mic over to you. If you need anything, I'll be right here. The floor is all yours.
Thank you so much. This is Avi Gilbert. Welcome, everybody, and thank you so much for joining us this afternoon or this evening. I'm going to start with a very quick primer on background on Elliott wave analysis, which is basically our primary method of analysis. And Ryan is going to take it over from there. And I will be jumping off, and Ryan will be handling all your questions from then point forward. So let me start with there's a common premise, of course, that news or political developments or international events are really what moves markets. And over the last 30 to 40 years, there have been a significant amount of studies that have been performed that have really been shaking that premise to its core. In fact, starting with a study back in 1998 entitled "What Moves Stock Prices," the people who did that study reviewed stock market price action after major economic or other type of news, including political events, in order to develop a model that they could then begin to predict moves retrospectively. That was the purpose of the study. Yes, and you heard me right. Retrospectively, they weren't even at a point of trying to develop a model for prospective predictions. What's interesting is that the study concluded, and I'm going to quote you, macroeconomic news explains only about 1/5 of the movements in stock prices. And in fact, they even noted that, I'm going to quote again, many of the largest market movements in recent histories have occurred on days when there were no major news events. They also concluded that, and quote again, there is surprisingly small effect from big news of political developments and international events. And one of the conclusions was the relatively small market responses to such news, along with evidence that large market moves often occur on days without any identifiable major news releases, casts doubt on the view that stock price movements are fully explicable by news. Now, I know that comes as a surprise because, we're all looking at the market and the news comes out and the market moves, then comes back. But ultimately, the larger moves, as this study showed, it's not driven by that. So what is it driven by? Well, over the last 30, 40 years, again, a lot of studies have been focusing on a concentration on market psychology and how important market psychology is to the market and what an effect market psychology does have on the market. So and by the way, most of these studies have come out and said market psychology is actually the most important factor in determining how a market's going to move. But that's only the last 30, 40 years. The interesting thing about it was back in the 1930s, almost 100 years ago, a gentleman named Ralph Nelson Elliott had identified this. He saw that markets move based upon a structure. And the structure identified is what you're seeing on the chart in front of you. The markets move in 5-wave structures. It moves in waves 1, 3, and 5 in the primary trend, and waves 2 and 4 are corrective structures. What Elliott also identified is that markets are fractal in nature, meaning they are variably self-similar at all degrees of trend. What does that mean? Sounds impressive. What does that mean? Well, all it really means is that the larger fractals will fit into the smaller fractals will fit into the larger fractals, and it's just variably self-similar throughout the entire larger movement of the market. As an example, if you look at waves 1, 3, and 5, each of those are structured with 5-wave structures within themselves, and you can see it most clearly in wave 3. As you can see, wave 3 is further divided into waves 1, 2, 3, 4, 5. And it goes on and on and on like this, no matter what degree you look at. They're variably self-similar at all degrees of trend. And this is something Elliott discovered back in the 1930s. And what he explained to us was this structure is how we track market sentiment. After a 5-wave move, the markets are ripe for a reversal. And when it reverses in a 3-wave pullback. And after a three-way pullback completes, it's ripe for a reversal in the other way. And that's what Elliott identified to us almost 100 years ago. And believe it or not, it is one of the most effective ways to track cryptocurrencies, because there is so much emotion that is driving cryptocurrencies. You can't say that there is a huge amount of fundamentals involved. People try to explain what they see, but you know what? It really is, providing reasons for what happens is great after the fact, but it doesn't help you beforehand. What Elliott Wave can do is it can give you some very high probability turning points in the market, and it gives you something that no other methodology can give you, and that is market context at all degrees of trend. And this is where I'm going to hand it off to Ryan, because Ryan is going to take you through today basically the market context for where we are in the larger degree crypto perspective. And then he's also going to take you through, well, what to expect from here. What are the parameters that Elliott gave us almost 100 years ago? What are the parameters that can give you some good ideas about where and when to expect some major turns, and how much further the downside is going to take us, and where do we look to on the upside? So without further ado, I'm going to bid you all a good evening. Thank you so much for attending, and I'm going to hand off the ball to Ryan right now. Ryan, it's all yours.
Thank you. Okay, without further, before I start with the presentation, I just want to say thank you for attending. As always, I give two QR codes. One is the left side is to the Elliott Wave Trader cryptocurrency service. We offer two weeks free trials. We don't chase you down. We are not a hard sell organization. We don't even take your credit card for the trial. So check it out if you're interested. That's about all the marketing you're going to get from me. And then as well, this presentation is there for your taking with this QR code on the right. And if you're old school, you haven't mastered the art of QR coding, there are the links there. And I will during Q&A, I'll take it back to here. So if you haven't grabbed it already, don't worry. I will flash back to the spot during Q&A. I think I've been well introduced. Also, I just want to give you, if you get the presentation, do review some of the calls I've made over the years. They've been very, very good at calling major turns in the market. You'll notice the last one is I've been looking for 100K Bitcoin prices since 2019. Still waiting for that, right? And they will end this presentation with price charts, and we'll talk more about that target before we finish up. Disclaimers, the main thing is that cryptocurrencies are an extremely volatile asset class, and nothing I am saying here means that it's right for you. I do believe crypto should be a part of every portfolio, especially Bitcoin, secondarily Ether, but that does not mean it's right for you, and do your own research and consideration of its volatility. With regard to this presentation, again, I'm gonna talk about macro a bit. I'm gonna talk about macro a little bit tongue in cheek to a degree, although I respect the art of macro, but I'm not a macroeconomist. I'm a technical analyst, and more specifically an Elliott Wave analyst. And on top of that, you'll see that I'm a student of market sentiment, and I color the picture with that view. Unless you have lived under a rock, you understand this page. We in the United States have lived under a loose monetary regime, and for me personally, I started trading in 2000, right about the time of the tech wreck, and it was about that time where the spigot started to really open on the monetary policy. And so I personally have traded within a loose monetary policy for 20 years now. And of course, the big worry of the market is that tap has, or the worry is that tap has turned off. I'm actually going to question whether it has really been turned off in this presentation, but the market has acted like it has. And of course, the market has, been worried about recession. Of course, that's the important topic du jour, and also the topic in this presentation. But if you look at the news headlines, we don't even know how to define a recession. Are we in a recession right now? Are we not in a recession? Is it GDP? Is it jobs? I mean, the reality is GDP has been pretty anemic in the United States for quite a long time, as it has in the developed world. But look at our job rate. It's strong, strong, strong. Of course, that could be before a major turn. And of course, pricing is on everything is still a seller's market. So never mind that the stock market has come down a bit and Bitcoin has come down quite a lot. That is still a case. Now, what's interesting to me is that I've been in crypto since 2015, and during that time, Bitcoin was born after the financial crisis in 2009, and that was the date that the Genesis block was printed or mined, so to speak. And so Bitcoin has always lived in this loose monetary supply, or this loose money supply and loose monetary regime. And the current wisdom right now is Bitcoin should continue to drop until the Fed opens the tap again. This statement here is a statement very much, I would say, expected across the market. I'm just going to quote one podcaster. This is a podcast that I love, the Bankless podcast. I learned so much about corners of Bitcoin or crypto tech that I wouldn't have a chance to learn on my own. Ryan Sean Adams says the macro is still not doing what we want it to do, and this podcast was going to talk about latest development in Ether and whether those latest developments would take Ether or Ethereum higher despite this macro environment of Fed tightening. You can see very clearly that Ryan Sean Adams holds that belief that crypto is going to keep going down until the Fed opens the tap again. I say personally the crypto market is drunk on macro, and I say that because it's taken itself into a stupor over this issue, and I think it's quite funny. I mean, again, when everyone in a market is saying one thing, that's often when it's right for a turn, but ultimately I follow price action. But I can say, as someone who's been in crypto since 2000, I said 2015 earlier, actually 2012, I have never seen the crypto market so concerned with the macro environment as it has today. And I think a lot of it has to do with institutions being in the market, a lot of training from the news industry inside the crypto space, and on and on. But it's funny that it has never worried about it until now. Now I want to dive into the condition of rates right now real quick. And so the blue line here is the Fed funds rate, and then we have the bond market. And the reason I'm comparing the Fed funds rate to the bond market is to make a real important point, and that is, I would say that the bond market is the most directly, fundamentally correlated market to the Fed funds rate. It's very natural, right? Fed funds rate has to do with the monetary lending rates of the lender of last resort, the Fed, to the rest of the banking industry. Bonds are sort of a derivative of lending rates, on and on. I mean, I'm not the best explainer of that, but it's the most tightly correlated market. So even with this market, you can see that bonds are not perfectly correlated to the Fed funds rate. In fact, the most salient point with this chart is this sort of secular decline in rates we've seen since early 80s. I mean, if I zoomed out, you would see it since the early 80s. We've been in the secular decline in bond rates, which is to say that the bonds have rallied, and the Fed funds rate undulations, while they've also been a secular downtrend, they have, so I would say that both the secular trends, of both the Fed funds rates and bonds are following the same direction, but the individual cycles of the Fed funds rate have had only some sort of correlation on the 2-year bond yield, and really very little to do with the 10-year bond and the 30-year bond. And I'd argue if they don't move the cycles in the 10-year and the 30, how could they possibly have anything to do with Bitcoin? Okay, for one, Bitcoin is a global market. I mean, arguably treasuries are as well, but Bitcoin is a global market, and one that also serves, has exceedingly served emerging markets where Bitcoin has grown the most, which has very little to do with treasuries. Emerging markets don't tend to, or I would talk about deep emerging markets like African markets, have very little to do with treasuries. The next slide. I was actually surprised by this because I don't track the Fed funds rate so much, except for in my own personal intraday trading. I like to pay attention on Fed days because you often get some very interesting market action in Bitcoin, or I also trade index futures. So I often make plays even in gold based on Fed funds rate. Next one is tomorrow. I'm looking forward to it because they're always very interesting day trades on those days. But I backed up here and pulled out the chart, and it's like, hey, wait a second. During this latest climb, we haven't even reached the pre-COVID funds rate. And here, and we weren't talking at all about an over-tightened supply. I know we had some problems in the repo market back then that were really related to tightening monetary regime, but we were rarely talking about it. And here we've raised, we're still about almost a point away, interest rate point away from that previous rate, and yet we're all up, we're just losing ourselves. I mean, we are, like I said, drunk on macro, so to speak. So it's quite interesting to me that now it's an issue per se. And I bring all this up because it's keeping a lot of people out of crypto. And again, like I said, it's keeping the crypto players that have been around for a long time in kind of a malaise. So it's really interesting to me. Now I want to zero in on Bitcoin in recession. Kind of pull away from macro. My main point about macro is that don't oversell it. I do, don't get me wrong. I think macroeconomics is super important, but in individual trading investment decisions, I think you have to take it with only part of your funds, or it may depend on the time frame you're trading and whatnot. Okay, but let's talk about the two faces of Bitcoin. So the Bitcoin prices do seem to benefit from loose credit and solid liquidity. But I want to unpack that a little bit, because we can only say that because Bitcoin has only existed in a loose credit and solid liquidity, and it's now at about 13 years age, and during that entire time, Bitcoin has risen. It averages around, I don't remember where we're at now, but about 150% average growth rate in price. So when you make a statement like that, and I am making a statement like that, you can only say that because we haven't seen it really exist within a tight money supply. Today, we are not in a tight money supply. We are in a tightening money supply environment, but not in a tight money environment based on history. Okay. Bitcoin also has a use as an asset when institutions fail or under pressure. That is the reason it was designed. Okay, and I bring that up because as we go into recessions, we may see some bank challenge. I mean, if it gets serious, and I think we still have a question how deep this recession is going to go, and of course we have questions whether we are actually in a recession, depending on who you are. But if we do see a real recession or even depression take hold, Bitcoin was designed for a failed financial system. I mean, if you don't understand what I mean, go read the white paper. It's readily available, and you'll understand what it means. Now, if you also look at emerging markets and its examples, I'll just raise a few. You can do your own research to unpack and expound, but it has benefited such cultures that have seen failed institutions, basically. So, if we now, I know this is an oversimplistic view of cycles, and I'm choosing just to be very simple for the sake of illustration, but Bitcoin has lived over here on the left, and as we go into recession, Bitcoin has never been here. Okay, and then eventually recessions, of course, can turn into debt crisis. Okay, now I know I'm oversimplifying it because whether a recession is really deflationary or inflationary makes a lot of difference in the character of how asset prices tend to pan out in that recession. Gold may behave in one way from one type, and another, as an example, stocks the same. But the point here is Bitcoin has never been here, right? We've only been in this inflationary printing cycle. And again, if you look back at my charts and where monetary rates are, we don't even know if we've even entered into a tight monetary policy yet, right? We haven't even reached 2018 levels in terms of Fed funds rate, okay? So we'll see how that goes. But again, I want to point out here on the right that if we ever end up in a real debt crisis, which a lot of people are starting to talk about, I mean, people have been talking about it since I started trading in 2000. The US is going to go into debt crisis, and I'm not saying it won't. I've just said it's been a long time for this talk, and it's probably gone on before then, but Bitcoin was designed for that. Okay, so you know, Bitcoin appreciated, I did the calculation here, Bitcoin appreciated 7,300% during the loose money regime. Bitcoin dropped 70% during this Fed tightening cycle. Okay, but remember that that Bitcoin went up during the last tightening cycle into 2018, right? 2018 and 2020. So you can't really exactly blame the drop we have here. I mean, we haven't had enough history to blame Bitcoin's drop on this Fed tightening cycle. So, you know, I'm just saying, don't get overly excited about Bitcoin dropping further. And then further in debt crisis, we have some examples. We have runs on Bitcoin, which occurred in Zimbabwe, Venezuela, Argentina, and Hong Kong during their respective times of crisis. So if you're interested about those events, I would go back and look at what happened. Most of those news, you may have to dig a little bit, but the news on most of those events are readily available. Okay, so I'm going to move on to charts, but what I'm really trying to pull people is not, I don't want to pull people away from macroeconomics and weighing that in their portfolio decisions, but I am trying to sort of undersell it a little bit in terms of, I mean, as we've seen here, for one, we don't know how Bitcoin is going to behave in this because we have no historical reference. Two, we are only basing the belief that Bitcoin will continue to fall as the Fed tightens based on you know, its recent history, like really the last year. And three, we really haven't tightened that much, and we actually don't know where the Fed's going to stop. They honestly could stop and put a brakes on tightening anytime they want, and they seem to tend to follow the markets when making some of those decisions. So, you know, I would be really careful making personal decisions right now based on what's going on at the Fed, at least in relation to Bitcoin. Now, you know, looking at this chart here, and if you're familiar with my presentations, this should look very familiar with a couple changes, and I'll talk about those. If you are new to our work and you saw saw Avi's discussion in the beginning of this presentation, you should recognize that three here. The subdivisions of that three, just like Avi showed in his discussion of fractals, and then of course the 4 and 5. Now this 5 here that I'm projecting is top of an even larger 3. So the next 4 is going to be much larger, and then the next 5 even bigger than that. But we really want to deal with the present on Bitcoin because Bitcoin is so volatile on a macro stage that we really want to at least have, you know, we want to kind of focus in a little bit, because you get involved in big numbers when you start talking about sort of beyond here. And I've been looking for 100K, but if you've seen my presentations of recent memory at the Money Show, I had this 3 actually out here with another 4th and 5th, and it really needed to hold 24K to keep that. And by breaking 24K, and right now Bitcoin is trading at 22K roughly. No, sorry, 21K right now roughly. As of close today, roughly around there, maybe a little bit below. So we're well below and sustained below that level of support at 24K. So that caused me to have to drop this 3rd back to here and put a 4th. Now, mark my words, this 16K that I've got here is really the last level I have for this 4th. If we break below that, well, holding that keeps the door open to a move to 100, and actually because I dropped this 3rd back here, I've got a higher degree, 125 up to 188K. It will tend to be the smaller. But mark my words, if we get a sustained break of 16K, I really can't do this kind of juggling of the count anymore. I have to be honest to what the market has given us, and it should be a larger bear market. So we're in a critical spot. I mean, for me personally, I have done a lot of hedging as we broke key support up here at 42K. And I've been accumulating a lot down here, but I've been accumulating in such a way to keep it low risk to my own personal finances. And I would be accumulating below here. But before we ever get there, we are looking for 5 waves here to signal that 16K will hold. I actually see the 17K bottom that hit in June. If we don't get 5 waves here, and we need to move up to about 30K to say 5 waves, as shown off of this low, then that keeps the door open to breaking that 16K. So while I've asked everyone to back themselves away from macroeconomics, I am saying to you that the chart is not quite healthy right now. And so, based on all of the work that Elliott wave and using the fib work that a lot of refinement in our fib work has come from Avi's work, this chart is in a very critical juncture for getting that move up to 100K. Now, breaking here doesn't mean that 100K will never come, but it does open the door to much lower levels. 10K and 3K are the next key supports below. And 100K would come a lot, maybe 5 to 10 years down the road as it works through a bear market. So definitely we're at a key point. So what do you do? For me personally, Bitcoin is part of a long-term, basically a portfolio that includes cash. Of course, it includes Bitcoin, as I said, gold, and the SPX is sort of a general rebalancing portfolio. So I've been kind of filling that portfolio, or that bucket of my portfolio, with Bitcoin as it's dropped so much lower. I've been adding to gold and adding to the SPX and taking some of my cash out of the bank to do that. But in terms of getting aggressive, buying Bitcoin with 100K in mind, I need to see 5 waves. I'm not showing the micro because there's quite messy in a few scenarios that I'm looking at, but I really need that 5-wave pattern to the 30K region to say, okay, now we've got what we need to say this chart will hold. Other than that, we've got basically a daily downtrend, and we're at a key point where that daily downtrend turns into something much larger. Okay, so I'll give the key takeaways, and then I'll move to Q&A. So again, just as if we look at the Fed and its activity, I'm going to argue that the Fed can't even control the bond market. I mean, nothing beyond the 2-year bond has really any strong day-to-day correlation to the Fed funds rate based on the chart. I mean, it's clear that though there is a correlation on the large secular trend, but the large secular trend isn't what we're talking about here. We're talking about a Fed funds cycle that has changed in the last year as they started to tighten rather aggressively. But we haven't at all reached any sort of tightening that is meaningful from a historical standpoint. I mean, just look at the chart, and you can look at the sources on that chart, and you can look at it and ask yourself the same question: have we had any meaningful tightening at all? So don't make any assumptions based on the Fed funds rate. I mean, you really shouldn't. I think we need to pay attention, see where it goes and all of that, but I don't think we can make any over assumptions on the crypto market. Now, that being said, of course, as I shared, Bitcoin is a very key pivot. We are really at the last stand of the larger bull market that began 2018. I didn't really clarify this, but breaking through 16 actually says, from an Elliott wave perspective, that the bear market that started in 2018 never finished. It would, if you're familiar with Elliott wave, it would suggest that my 3rd wave is actually a large B wave, and it's really high. It's probably a higher B wave than I've ever seen in any other asset chart, but it just basically says that the 2018 bear market was higher degree, and although we broke out over that 20,000 high and went on to 65K or 67K, something like that, it never ended, and we've got basically a corrective pattern up into that 67K high. And that would bring us down. If you remember, the 2018 bear market ended at 3,100. And if you look at my history, I basically called that bottom, but that doesn't mean it necessarily has to hold after we've had this rally. We definitely turn around and break. I would be surprised if we broke 3,000. 1,800 would be the next level after that, but we do have pretty strong support between 10K and 3K on the way down. Okay, so that's where I'm at. I'm going to take this back to those QR codes in case someone is delayed in getting those up, and then I will take questions.
All right, then we do have quite a few questions, so I'm going to try and get back to the beginning here. This first question from Vor is asking, between stock and crypto, which is your favorite child for the longer term?
I don't think that that's an easy answer to give. I say both because you really should have both in a portfolio. But if you're balancing, crypto is highly volatile. And if you don't make use of the volatility, like, you aren't buying the dip, then, and instead you're selling when fear sets in, then you're really not doing it right. So I would say most people don't know how to fully use crypto. Even if you look at crypto miners, they haven't been able to use it very well because they've been selling their Bitcoin at the bottom instead of hedging it on the way down. The question, I think, is loaded with who you are. I'm personally comfortable with crypto maybe a little bit more than stocks, simply because I stare at it every day. I mean, I also trade index futures, but my attention is more closely on crypto, so I'm more comfortable with it. But honestly, here I'm buying both. I'm adding to my SPY, in my brokerage accounts, and then I'm adding to my Bitcoin holdings. I'm doing both very small right now. I think the stock market needs a more sure bottom. So does crypto, and both I think can go lower if they don't settle in. So I know it's kind of a non-answer, but I mean, part of it is because I think people need both.
I think it's a great answer.
Okay.
And we do have another question. This one's from David. He says, "Hi, Ryan. Bitcoin is still acting and performing like a risk-on asset. What needs to happen for it to truly become a risk-off asset? Would it be back to qualitative easing, the next halving?"
The Bitcoin will behave as a risk-on asset as long as sentiment is expecting it to. It really is that I see this person is trying to take what the whole presentation is teaching against, and then ask me, what news event basically is going to turn it around. And I'm just not going to go that way, because it's basically against the entire presentation.
All right, then we have this question from Kelly is asking, what do you think is the future of XRP, in parentheses, Ripple?
I think it's junk. Yeah, I'm sorry. I never mince words about it's a chart that has been in a downtrend since gosh, I haven't looked at it in a while, but someone asked for it the other day. If you look at its recent bull market top, it came much earlier than Bitcoin, and it has been a trend. In fact, one of my favorite trades to do over the lifetime of crypto, when we were allowed to short the crypto market in the US market. Since then, the exchanges have shut down. But I used to short XRP with Bitcoin as collateral, because XRP has a systematic underperformance of Bitcoin. Even when you're in a bullish cycle, it really behaves like a crap asset, and I would not own it. Just being plain.
A similar question with a ticker from Jack is asking, what's your latest view on GBTC?
I have been, if you look at articles on Seeking Alpha and same thing in the service, I've been suggesting to subscribers to lean any of their brokerage trading. Actually, I've done presentations of the same for the Money Show over the last couple presentations. I've been suggesting that people lean their brokerage asset exposure to crypto towards BIDO, the ProShares Bitcoin strategy, because we haven't seen the premium, or the discount, I should say, because GBTC sells at a premium discount to the Bitcoin inside. We haven't seen the discount close. It's now, I don't know where it's at today, but it's been hovering around 25 to 30% discount versus the Bitcoin in the fund. Now, I may eat my words one day if the SEC okays it as a spot ETF, because then it will instantly close. But we've just seen another decline in the last couple of months, and I don't think they have any intention of ever approving it. So I would just, if you're taking on new positions, if you're taking on new positions, I would go BIDO. I've been doing what I call grid trading, like basically lowering my cost on it to close my actual personal discount on it, to close it, because I still have some portfolio. But any just sort of raw new position, I've been using BIDO.
Thank you. This next question from Gunnar is asking, what is your take on the US crypto regulation timeline to aid in institutional adoption?
I think we've seen a very nice executive order from Biden. I think it was actually surprisingly reasonable. I think we have, I don't want to say timeline because I don't follow it closely enough. And now you're in a situation where the timeline really pertains to each agency. Of course, the Loomis bill, there's another senator, it's a bipartisan bill that if it passes, I don't know where it's at, it's going to be very important because it's a very good bill. But I would actually turn everyone to the Coin Center, which is a lobbying organization for crypto. They have a Twitter account that you should follow, and then they post a lot of articles, and they are far more knowledgeable on any of the politics than I am. I am a technical analyst.
This next question from Gerard is asking what you think about the investigation into Coinbase.
I assume they mean the insider trading. Well, it wasn't of Coinbase. It was employees of theirs, and yeah, it sounds reasonable. I think it's good of the SEC to go into that. I think it's interesting because I don't think in our actual law we have a rule against insider trading of a crypto per se. So I think it's interesting, I guess, because we're talking about listing coins. But if you saw recently, to help to back that lawsuit up, they had to now charge Coinbase with marketing unregistered securities. So I actually think the SEC has a really uphill climb on this one. But again, just like with the political stuff, I'm not a lawyer. I'm not a securities lawyer. I have a very cursory knowledge, having worked on my securities license, and so it's really beyond my pay thing. But I think it's pretty interesting. In terms of the crypto market, I see no effect, but that's just me.
Thank you. This next question from Howard is going back to that regulation of Bitcoin. Is Bitcoin a commodity or a security? And in your estimation, does that make a difference?
I think it does matter. I mean, we've had across the board statement from the SEC to the CFTC that it's a commodity, and that basically lets it, it's managed as a commodity and all of that pertains to that. So that allows it to be freely marketed, et cetera, et cetera. So yeah, I mean, I don't have to, you don't have to get your opinion from me. It's the agency themselves that have ruled it that way. So good. It's very good. I mean, we don't have to worry about it so much with regulation.
Next question from Abdul is asking your thoughts on the new gen coins that came out after 2019. Some are just establishing trend. Are there any particular ones to watch?
I do a weekly altcoin and equity report for my favorite altcoins, and I'm not gonna I don't even have it in front of me because it's quite a long report. It also has some crypto related equities in it. In general, I'll just give a general opinion. If you track, I have been now, so I first traded crypto in 2012. I got really heavy as an active intraday trader in 2016, I think it was. And so I've been through, the big cycle in 2017, which was beautiful, the tough cycle in 2018. Of course, we had a kind of a bullish year in 19, and then we've just been bullish ever since, minus the last year. And in every cycle, every new issue sort of has its day and then peters out. I always say very adamantly that altcoins are really poor long-term investments. So if you are buying and trading them, you've got to be on them, and you got to know when to get out. I cover some of those on a very short range. I can't think of any right now that I like because everything's got a daily trend down. I think, a recent level 2 Ethereum token or level 2 protocol optimism. I recently took a small position into it just because level 2 or scaling solutions for Ethereum tend to do pretty well. But that's a fundamental view. And right now, honestly, that chart looks terrible. I'm not sure I'll get my money out of it. And believe me, it was a very small position. I mean, like my general rule for an altcoin position is started off with half a day's wages because I don't care about half a day's wages. I can make that back very quickly, right? So that's my general rule. And I just see so many crypto traders chasing the hottest thing with like all the money they've got. And I just, I know from being in this business now for 5 years, most people have tears. So just, my point is, if you don't have an edge on catching those trends and know when to get out, just don't do it.
All right, let's see if we can get just one more question here. Alec has just asked, do you have any thoughts on ETH going to POS and it being a positive catalyst for Bitcoin?
I think the story is, the story still needs to be written. I mean, I'm an Ethereum fan. I mean, I use the DeFi quite a bit. I mean, mostly I use it on the Matic protocol because of the cost. So I'm a big fan of Ethereum. In fact, Ethereum was my biggest gainer in 2017, in the 2016 to 2017 rally. So I have such a relationship with it. In fact, when I was a member of Elliott Wave Trader before I was asked to join, I was called the Ether Whisperer, because that's what I was posting as a member on the site and before Avi hired me. But we haven't seen proof of stake protocols do well over time. And I don't know if the fundamentals behind Ether are very strong. And so, to be honest, I'm really nervous for Ether after it goes to proof of stake. I just think proof of work is we can make all the arguments about the environment and the energy usage, even though Bitcoin energy is much lower than the banking system. So we can make a lot of arguments about it, but it ties it to the real world and it makes it deflationary. So now the good thing is the merge, which will move Ether to proof of stake, is going to be deflationary for its monetary policy. So I think it's a mixed bag, and I nervously sort of bite my nails over what it does to Ether. But in regards to what it does to Bitcoin, I don't see any relation, really, to be honest. I mean, they're both highly correlated, but I don't usually see Ether kind of pulling down Bitcoin. It's usually Bitcoin that pulls down the market. So I really, when it comes to like actually knowing where the market is going, I watch Bitcoin, not Ether.
Thank you so much, Ryan, both for that excellent presentation and for answering all those questions. That does conclude our time for this session. So another huge thank you, of course, to all of you in the audience for joining us today. Be sure to tune in tomorrow for more excellent presentations.